SGX is down by 1.7, let's say about 2%, right? So the point I'm trying to make here is that we are falling, and we are falling almost 50% less of what US markets are doing. Now, are we likely to maintain this kind of a trend? That is the question. Now, why should we maintain this kind of a trend? See, this is not a collapse of the system. This is not 2008. This is not 9/11. This is not 2013. So obviously, it's a fear of a recession and a slowdown, which clearly is going to be having an impact in the near-term price dislocation.
Yeah, and I think the uncertainty factor is just so large at a time like this. Marc Faber as well is with us. Thank you so much for taking time out and joining in. It's a complete route across the globe at a time like this. Give us a sense, Mark, as to, how much of a correction territory we will continue to see for the global markets and, at a time when uncertainty continues to remain the key word.
Well, I think investors have to understand we are in an 11th year bull market, which started March 6, 2009. The markets, by any standards, even in India, are very expensive. Not all stocks, say oil stocks, are very depressed, but in general, the so-called blue chip or growth stocks are very expensive based on a price-earnings ratio and especially on a price-to-sales ratio. The market capitalization of world stock markets as a percentage of the economy, of the global economy, are all very high. So I think this is not just a correction. I think the coronavirus was the catalyst to a decline. But the deeper reason for a decline is that by early February, markets around the world were A, overbought, and 2, expensive, and 3, disregarded a global economy that had begun to slow down in 2019. We have many indicators that show that many countries were in recession already in 2019. But investors, driven by media such as CNBC and Bloomberg, were still buying stocks and thinking they will always go up. So all I'm saying is here, this is not just a picnic. This is something big. And I would advise your investors not to panic, but to think rationally and to wait for a rebound and sell on a rebound and reduce their positions. I'm not saying sell everything, but if someone has 100% of his wealth in stocks, I would reduce it to less.
One side is that markets or equity markets have also come down. But on the other side, because of this entire risk-off trade, crude is down, bond yields have also come down. So for a market like India, do you think indirectly this is good news because India's macro are dependent on crude and cost of liquidity? In both the cases, since bond yields have come down and crude has come down, do you think when the selling subsides, India will start outperforming very, very smartly?
No, not at all. Indian investors and the media in India have always pointed out that India is a special case and that if crude oil prices go down and so forth, it will be beneficial for India. Yes, to some extent. But if Indian stocks, the blue chips I'm talking about, are selling at 40 to 50%, at 40 to 50% PEs, price earnings ratios, I think the market has a significant downside risk given that the coronavirus is destroying the entire conference industry, the entire traveling industry, business travels as well, the hospitality industry. For a while, nobody was going to travel. So I'm telling you, I think India is as vulnerable, if not more, than other markets.
Mark, over the years I've interacted with you, now it's almost 20 years now. You always like to talk about one trade or one asset allocation or that one exciting thing for as a mega trend. So if Marc Faber has to, let's say, trade or invest only once for next 3 to 5 years, where would you put your money? Long or short, asset class, anything you can, it's open, Mark.
Well, this is a very good question. At Christmas, I wrote a report for the next 10 years. I would invest in platinum. And it performed well for a while, but now it's also been weak. I think for now, if you ask me, I would increase my cash allocation and wait. Patience is very important in the world of investment. I would be diversified, stocks, bonds, cash, and real estate and precious metals. But for now, right as of today, I'd say all assets are vulnerable, all of them.
Really appreciate your time. Highly obliged that you took this call and took this interview request and gave us very candid views as to what you feel where markets are headed. That was Marc Faber. He's got a reputation of being called as a gloom and doom and a boom expert, but he's been fairly accurate in getting his long-term predictions right. I mean, 2011, he said, look, you're going to buy commodities, and then commodities went into a bull run. Then he said, you need to revisit blue chips, US blue chips, and US blue chips have been in a bull run. I guess right now what he's making a case is that US blue chips are expensive. They need to come down. Indian markets will get affected because of that. However, he feels it's important to diversify. Let's look at gold prices and then we'll take a break, because today we've got a packed show. We're trying to decode both global voices and local voices just to establish that where markets are headed today in the short term and what you should do with your money. There is a difference in risk and volatility. Let me say it again. There's a difference in risk and volatility. Is this volatility or is this risk? I don't think it's risk. It's volatility. Volatility is investors' best friend. Risk is when the system is going to collapse. Volatility is when markets go back and forth because of an event. Now, when markets fall, we think it's risk, but sometimes it's actually volatility. That's what we need to decode for our viewers. Is this risk? Is this volatility?